and welcome to week 33, running from the 15th to the 19th of August. As always, we will start with the economic calendar. We will leave the calendar here for a few seconds for you to take note of the high-impact economic news events. The red-marked economic news releases are the one most likely to see increased volatility, so please take note. All times shown here are in Singapore Standard Time, which is 6 hours ahead of South African Standard Time. This week, the main event to take note of are the central bank events in Australia on Tuesday, New Zealand on Wednesday, and the real big one is the Fed with the FOMC event on Thursday, 18th. So, from last week's analysis, we noted that we would likely see market consolidate until Wednesday's CPI inflation report release, which would see volatility injection into the markets, and like clockwork, the market delivered. We also mentioned that the layered volatility above price back then would see the dollar dropping lower, and that happened in style. We saw Monday, Tuesday consolidation templates work out. Then price dropped majestically on Wednesday. We marked Wednesday, Thursday, and Friday for your reference. If this price action was happening outside of a mid-summer low liquidity time of the year, this short dollar campaign would probably complete around the 103s. Price is now retracing upwards, and we like that. We will look at the hourly graph later to identify trade levels, potential trade levels where we could short this market. Moving on, the bearish trade expectation we had on the dollar index was expressed nicely in the euro dollar, which rallied after consolidating for 3 weeks, as well as the commodity currencies, which we will look at in a while. Here we contrast the dollar index on top of the graph and the euro USD on the lower part of the graph, and you can see Wednesday's move in the euro and the retracement post news. Moving on back to the dollar with the hourly graph. Again, if this was not a summer low liquidity time of the year, this sell campaign would be cleaner and move lower to the 103 price, rallied nicely in early Monday trading. We will be looking for clean short setups. We will probably express them in the commodities and or commodity currencies. This week we have very strong inflow of funds in both crude oil and Brent. But in the face of weakening dollar, the big trades could come from soybean meal and coffee. These could really be mega trades in these markets developing in the coming weeks. Dollar CAD 4-hour graph. As mentioned last week, the CAD has and continues to see inflows. The CAD had and continues to see inflow this week as well. The dollar did weaken against the CAD, and we saw the bearish move materialize after the CPI news on Wednesday. We still like our targets here at 127.15 and 126.50. However, it's still summer months, and this increases the probability of choppy sideways moves, so you may want to manage your stops accordingly here. Here we compare, in this graph, we compare the Aussie USD, the US CAD, and the Kiwi dollar, the New Zealand dollar pair. Of course, as you may know, the Aussie, the CAD, and the Kiwi are commodity currencies, and it's easy to compare them in such a manner by putting them in the same chart. Note that the US CAD, US CAD is inverted. Currently we are overbought in these three markets, so we would like to see a retracement down ahead of the FOMC on Thursday, and we may evaluate opportunities from clean setups on any of these three markets. Looking at oil against the dollar index, we notice immediately that oil is very oversold but still weak. Zooming into the 4-hour graph for crude oil, we're starting to see some bullishness in crude. Notice that a swing high was broken in this time frame. However, price action does not convince us it does not convince us here. So we are open to a bull trap, and we will be looking for price to move lower and clean buy setups to form around the 86.50, or should the support around this level fail, we will look for support around the 79.50s. For the desk here to be convinced of a solid move up, developing and swing trades and moving to swing trading instead of intraday, we would like crude to move above the latest swing high beyond the 101.88 level. Moving to the cable, pound dollar. Markets are looking for a rate hike here from the Bank of England meeting in November. Rate hike news would bring expectation of a rising cable. However, we're not seeing noticeable increase in positioning from market participants buying into this expected rate hike. On top of that, we are seeing conflicting signals from price. So here we zoom into the daily graph of the pound dollar. We can see that price has broken above a prior swing high here, and price is respecting this level cleanly and is consolidating. Again, if this were to happen outside of the summer month, this would be a nice bullish indication, and it would suggest an accumulation time here and a move higher. However, we're not convinced yet, as last week the cable was unable to continue its move up after rallying on Wednesday's US CPI release. So cable is giving conflicting signals suggesting that a longer consolidation could be in the cards. While the chart does suggest a bullish tone, the combination of bearish market sentiment and the low liquidity environment that is typical in summer months suggests that any trades taken here should be considered short term, i.e. take partial profits at logical levels and protect your stops when feasible. All for now. Good luck and good trading.